Three minutes, probably too fast. Let me just try. Let me try it.
That's the favorite color on there.
Hey guys, what's up?
My favorite color is red.
Hello,
Okay.
From one algorithm to another.
Oh man, I don't know. Like I said, I'm feeling like I should be doing anything out of the ordinary between now and Thursday. My day is over, and I just want to spend some time and chillax. That's a blunder.
Today's been wild though.
Wait, I can go knight takes. No, but then bishop takes. I have to do this. Then he takes here. But I'm already castled, guy. So I don't think it packs the same punch. So now I'm just going to open here. Immediately. And do this. That's a bad. Oh, whoa. I almost blundered. Oh, what do I do here? I don't have the luxury of time. I'm just gonna go for it.
This is business.
I may have messed this up. How do you do this again? I need to hide this here. He's getting away with that. Doesn't matter what I do. Maybe I can do no. That doesn't work. I'm losing this. I am losing this game. Unless I
Not over to the fat lady saying.
That's true. I'm gonna try to trick him anyway.
Make him blunder.
Yeah. It's probably going to go here. Figured. What I expected that. Rook takes pawn is move. Nope. He did rubbish. Wow.
Oh, I thought he would have took it.
And no, I'm losing for sure. If he plays here, then I'll just resign. Yeah, now I can resign. I won't finish this. But I'll throw in a couple analysis here and there. Answer a couple of questions if you guys have questions. I'm in the mood.
Yo, the volatility today was crazy.
I mean, well, we open with a 1,000 point down gap.
Yeah.
All right, that's just stupid. Usually, markets don't expand continuously like that. So the moment I saw that, well, even before I don't think I shared the planner. Usually, I share what is this? Usually, I share a weekly planner, my expectations for the week, stuff I plan to do. Hey, what's going on? But I didn't share the one from last week. It's a nice trick, but it doesn't work. It doesn't work. Pretty sure it doesn't work. I should come out up a piece. Exactly. Doesn't matter what you do. I'll still be up a piece. Pretty sure. That doesn't work. That definitely doesn't work. How do I win this? I drop this pawn. He pushes here. I need to get this. I need to get this rook. I need to get this rook in the game. But yeah, the expectation for the week is that if you look at the low of the year so far, this is just a free piece. Thank you. My expectation is that we're going to draw to that sell side liquidity pool that was created early January 2024.
Looking right now. Let's see.
Yeah, so just go to the daily chart. I think it's January 8th, if memory serves me well. That's the draw on liquidity, I believe, for May.
Oh no, on the 4th of January.
Let me see if I can find it.
I think so, because I got the same thing.
You looking at futures or CFD?
I'm looking at futures.
Yeah, probably it's a little bit different. I'm not logged in over here. It'll just work.
It's like a monthly FEG, I think, there, or like a 3-month quarterly.
I think so.
Yeah.
I don't remember. I don't usually do charting on this this account.
Non posso restare, sono in servizio. Senti, tu conosci...
So this is what I mean. We're here, so it should be pretty close. This low right here.
Yeah, right there. Yep. Okay.
Where's the tools? This one. So roughly about here, yeah, January 8th. I think this is the delivery expectation for May, but we are in overwhelmingly bearish environments. So I don't think them reaching the objective makes sense. So I'll share a picture shortly, but essentially I'm looking for this idea. Where is it? Where's the Where's the one with the arrows?
Wait, let me see. I think it's in the tech, maybe the icon or text or the trend line. Might
You
be
know
the
which one I'm
trend line.
talking about? It's like
Ye-
the line that allows you to connect like multiple points.
Oh, yeah.
I think it's a
It's the
drawing.
Drawing.
yeah.
Up
You see the brush?
with the
You see the
brush.
brush?
Oh,
Yeah, right there. And then the path. You want to do the path? Yep.
so usually when you have a clear drawn liquidity like that and the market's expanding towards it early, you get this type of delivery where it goes, just put arbitrarily here and then this,
Mm.
right? But because we're in a bearish environment, this leg is not expected. So basically, when I look at this piece of price action, I'm looking at this
It's
push
fine. It's fine.
and
It's fine here. You don't have to go in.
and I'm looking for
Thank you.
a push down fails around
Retracement.
mid-month,
Mm.
let's call it there, and then that happens, then we go something like this, and we go again. This is my expectation for the next 2-3 months. So when we so here's why it was a little bit tricky for me. I shared this PowerPoint with this outline at the close of Friday because I thought this week we'd get a chance to sell down, buy back up, and then keep going until Thursday. I make a more informed decision as to whether or not this push gets all the way up here.
Because of the CPI?
Yeah.
Okay.
CPI. So instinctively, the plan is Monday should make the high of the week. So Tuesday is either going to stay inside or Tuesday continues higher. Then Wednesday, Thursday, we see the high of the week put in and then we start trading low. Since this has already happened, like the gap down has happened and the move up has happened, when you take that into consideration, you're looking at something like this. I'm looking for the gun. There it is. So we're not playing around with this. All right, let me take off a couple of these unnecessary.
Yeah, the time levels. Yeah.
Shouldn't there be a box there? Just click and it takes them all off.
You might want to add the left. Oh, never mind.
That's good. That's good.
Yeah,
So
yeah.
I'm looking at this as the range here, and this and this high right here is premium liquidity, given the fact that we've already broken below there. Right? So now all of this so I'm just used to clicking the favorite bar down here and everything is there. So I have no idea. Where's the little thing that we used to use when you join the FPGs?
The box, it's, let me see. It should be a rectangle. It's right above the text.
Okay. You've been here?
Yeah, right there. And then the rectangle.
There we go.
Yep.
So all of this is now premium liquidity. So you have premium liquidity, a buy-side liquidity pool that you feel confident is going to get taken. So for the rest of the week, wherever this ends, something like this, and then a slow grind back down.
Yeah.
And whatever they do here, we'll make a decision around that. So yeah, sneak in that little analysis portion for now, and then I'll get back to play another game, unless you guys have any questions.
Yeah, that's what I wanted to see. For the rest of the week today, I got chopped up within that 4 hour wick that got made today. I got chopped up in that.
What was your plan for the day?
My plan was to wait for buy side. Well, I had the same draw that you have,
Mhm.
right, for the week, but my plan was to wait for buy side to get swept, and it was like a 4 hour fair value gap
Mhm.
that it traded up towards, and then I used SMT to take a sell. But like where I got in, it was like at a discount, and I got chopped up in that. But I took a second trade, and the rest of that it went down, but then it started ranging. So I'm like, oh, they must be generating liquidity or something.
Yeah. This guy's
Yeah.
trying to put me here to go here. I don't think it make any sense. Okay, cool. Didn't go for it. Still aggressive. But CPI day should be everything we want and more. So now it's just a matter of can we stay patient and not do anything until then.
Yeah.
Don't go messing up your account.
Yeah, I'm trying to crawl out of drawdown right now.
Challenge?
No, on the funded.
Oh, okay, cool.
Yeah. I'm not trading the funding in this type of condition though, because I can only risk because it's a 50K account, so I'm only risking like $125 per trade. But playing with NASDAQ in this type of condition, for my stop to feel safe, it's like a $300 risk, $400 risk.
Wow.
Yeah.
I mean,
know.
to be realistic, the only time I traded today was around 11. Traded for about 30 minutes and then ended the day, and then I scalped 2 trades after that. But the thing is, when you start seeing, if you trade one particular market, like for us, it's NASDAQ. So you know that generally a 5-minute candle will go 20, 30 points and, we're good. When you start seeing, more than that in one minute candle, then
Yeah, that's insane.
something is going on. It might not be something that we know, but just recognize that
Yeah.
it's not well. So for me, that was a no-brainer to not look to participate today. What is this doing?
Yeah, I was trying to be a little aggressive on the evaluations
Why?
today. Well, I thought it was gonna go lower and attack the liquidity that was made around, what time was it? Let's see. Basically around the Asia, right below Asia.
NASDAQ is
Yeah.
that life right now.
Basically London like the 3 o'clock low. London low.
Are you still in stocks, Kish?
Huh?
Are you still in stocks?
Local stocks? Yeah.
I would like to do like a lesson for us how we could, well, after we make the millions, how we could invest.
What's your prediction for 2025? Did you see like 30-40% drop from all-time high?
Was that for me?
Yeah.
Repeat the question, please. Didn't get it.
Yeah. What's your midterm or like long-term prediction for 2025? Did you see like 30-40% drop from all-time high?
Yep. So there are a couple things that makes this year ideal for just drops. One of those is the fact that we have a new president. Generally, that brings its own level of what would you call it now? Policies. So whenever we're looking at news data or somebody specific having a conversation, we believe that it's the numbers that carries that volatility. It really isn't. If you watch a lot of news releases, you'll see the expected data versus what actually came out. And most times you'll see that the data comes out and nothing happens. But when somebody is given a position of power, whatever what's that word now? Their beliefs are on certain things, it's going to drive the decisions they make. So this is not a political conversation. Nothing I say here should be construed as anything but the ramblings of a speculator, okay? Not financial advice. But we've seen where Trump stands on certain policies, and his desire to make America great has been shared countless times. So that means he's going to stop any outside entity from having any type of great influence within America. Full stop. Okay? Again, my opinions. Now, since the last time Trump was in office, if you remember how the gold market kind of reacted every time he said anything, it was just wild. Anytime he went up against China, it was just wild. So him coming back into office, the first thing you're expecting is he's going to go at China. Full stop. So how can he go at China from, his position of power? It's going to be tariffs. So that means there's going to be two sides of the coin. On one side, it's going to be, oh my God, all the companies inside America that import goods are going to be in trouble because there's this huge tax on China. And then on the other hand, it's going to be, well, Tesla is one of the leading manufacturing companies in America, or car production company. But China has a whole lot of viable alternatives. And they're on the rise right now. Right now, a whole lot of China electric cars, their efficiency is pointing fingers over there. So persons are going to start gravitating towards the cheaper solutions in comparison to what a Tesla would cost. If you don't make it expensive for those alternative options to come in the country, everybody's going to flock to them. But if you make the alternative more expensive than what you have, then it's in everybody's smart financial interest to stick with the evil. If a Tesla costs $100 and it's going to cost $150 to import a Chinese car that is technically better, I mean, the Tesla is good, so why not just stick to the Tesla? So when you look at things from that standpoint and you think of other markets, not just the car market, you see why the stock market has to go down. Right now, it has to go down. That there's no stopping it. I'm not saying a recession territories, but once the stock market starts to fall, everybody's just going to say recession, recession, recession. So a whole lot of selling and liquidation of assets is going to come in, especially around the monthly expiry. Quarterly expiry, even worse. What does that mean for the market? Between the first and second quarter, we have to drop hard. Hard, has to drop. But when it does drop, it's going to force that helping hand element to come in. And what that means is when the economy starts to fall, interest rates, inflation is going to be impacted, whether negative or positive. We don't know. But let's assume that the economy is doing a really bad.
My GG, what you want?
And nobody wants to take a loan right?
Quickly. Yeah, man. How's everything? Yeah,
How
man.
will financial entities encourage people to take loans when nobody wants to spend money? That's a question I want to think about for a second, then I tell you what I think. If we're in an environment where nobody wants to spend money because everything is being devalued, companies are just losing shares, losing market shares. Nobody wants to buy anything. Nobody wants to invest because your money is depreciating in real time. So financial markets or financial institutions will still need to make money whether the economy is going down or up. They don't care. All they care about is what policies can I implement to make sure that at the end of the quarter, at the end of the month, at the end of the day, end of the week, whatever, my books are good. The only thing that they can do from the institutional perspective is to lower interest rates or levy for interest rates to become lower. When interest rates comes lower, everybody who owns any type of assets, they're going to take loans against those assets and use them as collateral, get money, and then essentially try to buy the bottom. That's what's going to happen next. When that happens on a large scale, it is what real pump is going to look like. So I know as algorithmic traders, we don't encourage the idea of buying pressure, but when conditions are being put in place to encourage mass buying pressure becomes real. We understand that it's happening because of some technical factors, and there's going to be some key level and blah 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 blah. All is going to happen, but the underlying element is that to save the economy from a recession, they're going to have to make funds available. Then you start hearing talks, about monetary policies from the government and all that, blah 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 blah. That's coming next, but I don't think that's coming until the next meeting. And the next meeting is pretty far away. So right now, markets are being driven based on sentiment. This is why, right? Whenever you hear about buying or selling pressure, and somebody explains it using that chart and says, look how buying pressure came in here, or selling pressure and all that. The reason those things work is because liquidity is not algorithmic. And that's going to go over heads for a little bit. The algorithm can distribute price at areas to entice participation, but the algorithm itself cannot, it cannot tell you to participate. It can only suggest things that they know people will react to. So for example, everybody likes to see a double bottom followed by a big rally, or a triangle pattern in the market and then some big rally or whatever, right? The algorithm can create those. When the algorithm creates those, real participation takes place. And it's not going to be pressure. It's just going to look like that because the algorithm is allowing liquidity to come in the market. That's why for today, or for this week, I was not interested in being a heavy seller. And I don't have the PowerPoint open on this PC, but I'll see if I can grab a snippet of it and show you what I mean. Should be in weekly planner April 7. There you go. Let me just check if there's anything on this chart not worth. Bam. Bam. Okay, so this chart is the last chart I shared with you guys. And that was back when we were looking for this to get taken, I believe. Once that's taken, this is now the next drawn liquidity, the low of 2024 right there. Okay. Big inefficiency here. So we talked about just now. And next slide. Copy. This is the expectation for the week. So, all of the internal buy side liquidity here on Friday at market close when this was being done. That's where it was. Push towards the liquidity, fail, followed by a rally back inside this range, and then that drop. So that's what I believe that's what we're getting now. So this, as messy as it seems, cannot be seen as, oh, the market has been dropping or falling from all the way over here. So this is now the bottom of the market. That's not sensible. What's sensible is to look at what we have here. This is the last time the market expanded, which means from a premium or discount, just basic analysis standpoint, there. This is premium. We reached into premium, sure, no problem. Did this sweep liquidity? No, it didn't. Which means prior to this run, prior to April 7th, the liquidity we are going to target is already in the market. First pool of liquidity has to be here, and then the imbalance. So you're looking for Monday to not be the high of the week. Maybe Tuesday we start running since Asian session. We don't know. We don't really care because I don't plan to commit to anything until Thursday. Right now, I just higher prices. So I'm looking to see Monday's high get traded through. How that's going to be done, I don't know. Because this environment here is not something you predict in advance. This is like over 1,000 points. 16.3. Yeah, that's a lot of move. The only thing I can say definitively is, from everything I understand, this high should go. The best way for that to happen is Tuesday or Wednesday sweeps it, Thursday caps the week, and then we start moving lower. If for any reason you wake up tomorrow and Tuesday is bearish, for example, it's trading lower, and the only thing is I'm going to be paying attention to is what happened in here. So for key levels, you could look at last week's close, this week's open, new week opening gap, 50%, all of that. See if those levels show you that we're holding in this, or it's moving, or just chopping around here. One classic weekly profile is a big Monday, Tuesday stay inside, Wednesday CSD, Thursday retraces, and then it's gone. Or Wednesday runs to liquidity, sorry. Thursday gets heavy, Friday runs up in the PM or on some driver, then it tanks again. All those are things that you know. There's nothing strange about that. But that tells you that here we're missing a whole lot of candles. If we're missing a whole lot of candles in this delivery, it's not ready to leave this range as yet. I don't see this happening. I don't see this. I don't see 19,000 happening again, or 19.8 to be fair. I see this and then more downside. So that's my long-term view. When we sweep this down here, it's going to be about what's the sentiment in the market? Are we still heavy? Did some kind of agreement get signed that says they're going to stop the tariff? Some treaty or something. Interest rate. Do we have any interest rate information coming out while this is being swept, just before it's being swept, or right after it's being swept? Some catalyst has to come in just before, right at it, like the very day, or right after it. Outside of that happening, this is just going to keep going down. So let me just put that there. If nothing comes out that shows any type of agreement between all involved parties, this keeps going down. And this is going to be the last daily expansion range that we can use to frame premium or discount. And these are going to be very important levels. You're going to see reactions there. Whatever it's going to look like, I don't know. Either it's going to be a run on internal, maybe it's a big wick, then it comes back down. Maybe it's an order block type structure. I don't know. When we print at the levels, then we make more informed decision. But yeah, Fed going to jump in. Yep, that's it. This is the L I took. Let me see. What time is this? This is 12 o'clock. It's probably 11 o'clock my time. Let me just check. This is UTC -4. All right, let's take a look at it. What time frame is this on?
Kind of on the 5 minute.
Yeah, and I'm just syncing my charts.
Oh, okay.
The vertical line. And I want to go at least 7 o'clock. 7 o'clock because I know that some persons are in New York. So this is 8 o'clock for you. And that's when I believe we should realistically start stalking setups. So first thing, it's 7 o'clock. We're going into the market with an underlyingly bullish bias because this level
Hello,
Hola.
how are you doing? How is your rooster?
I have no idea where he is right now. He probably doesn't know I'm on a call.
It's going for chicks.
Not sure. All right, so if you're doing, there's two ways we can look at this. If you're doing analysis right at 7 o'clock, this is the information you have to you. This is the closing price of Friday. This is the gap. I personally don't give 2 pennies, or I don't really care about the new week opening gap like that. But if you do, then you could fib here to here and frame your levels and all that good stuff. What I'm looking at is this structure here. We're bullish. The market opened, traded down, swept a little low. This is in the market. This got swept again, which means it ran sell side twice, and then we made a new high. Okay, so in my mind, this is where the market is going to tell me if we take this and retrace, buy. Full stop. Okay, so going into the market, if we take this and retrace, buy. We took it right here. I'm looking for a retracement to buy. Did I get the retracement? Not really. We didn't go back below here. So now I'm focused on here up to the first time green candles stop closing above previous high. And that comes in here. My day is done. Everything I need to trade is now in the market. If I'm going to go short, I'm short. This is like 5 p.m., 5:35. Where is that rectangle? Wrong one. Rectangle. In here. Here we go. Bearish order block. Hey, what's up? What? Elmo? Okay, tell mommy. These are the important elements of price action. Sell side bearish order block, sell side liquidity. I'm bullish, which means I want this and then I buy. If I'm bearish, then the scalp should just make themselves obvious. 115. It's a 100-point candle. Let me just point that out. So if you're looking to trade, automatically you want your entry above 50%, or you don't want it because the risk is just too much. This happened, then we broke lower. This is probably 34. It's about 50 points. So if you can get halfway into that candle, you can have a nice enough stop for a run back into this range, and then ultimately the sell side liquidity. So before we do anything else, that's the game plan. Bam. We had a couple opportunities to go short. Then we had sell side liquidity taken. As usual, if this is being done, the run on sell side liquidity is taking place after equity is open, then you know what my plan is. I'm gonna find equities open here. Here. And I want 2 minutes after equity is open. So we're gonna go to a 1 minute chart in a second, right? I want 2 minutes after equity is open. That low, sell side, order block, CSD, trade higher. When we get that, this is all we care about. But this and the drawn liquidity, because that's the gap closure. If you're using this candle as your order block, it means you want that high taken, a retracement, buy. There's nothing else. Anything else you want to add to that process is just you adding whatever you want to add. So that's that. If you are observant, you look at this and say, okay, this is probably something that I should keep. But anyway, when you look at this and you have your clear sell side liquidity run, most persons are so in tune to trying to get an entry. The only thing you pay attention to is a change in the state of delivery. But you don't know what that means. Yes, I'm sorry, it is the truth. You don't know what it means. So the only thing you look for is down candle high, retrace, I enter. You have no element or what's that? Some word I can't find of whether the market structure or the order flow is bullish or bearish. You're just all about entries. This is an expansion to liquidity. When you have a clear expansion to a pool of liquidity, and I mean, when I say clear expansion, I mean down candle, close below, close below, close below. This is clear, which means all of this started here, right here. When you have that, it makes this line very, very irrelevant, and that open price your best friend. Everything you want is going to come from here. Expansion down, expand higher. This is where inefficiencies are born, right there. So on M1, I can show you how I could have found an entry here, but just gonna walk through the delivery in a second. Inefficiencies start here. All of this is inefficient until we get back below it. So how do you read that price action? You focus on the drawn liquidity first, which is here. Then you focus on the start of that run. Inefficiencies should be second nature to everybody. But on the off chance that it is not, once the delivery starts, everywhere there's a green candle, you want a red candle as well. So green candle, red candle, then nothing but green candles. All of this up to the last green candle is inefficient. Now, spotting this after a while is going to be a no-brainer. But how do you use it? So it's going to separate men from the boys. Inside here, until red candles pass through this, don't want to be a buyer. You don't want to be a buyer. I'm not saying you cannot buy. I'm saying you don't want to be a buyer. Okay? You don't want to be a buyer until a red candle closes at or below this candle's open price. So we pull that out and we wait. At this point in time, when this candle closes at 9:35, allow yourself to be a buyer. That's it. I don't know what the setup is going to look like, but it's going to be super obvious. It's never going to be something you have to worry about. It's going to be super obvious, okay? Eyeballing this, expansion, fails, order block, CSD, long, internal liquidity, game over. Your trade ends right here. And this is 234, and this is enough. You're done trading right there. Everything else that happens inside here is going to be an element of price trading inside an efficient range. So let me tighten this up a little bit, body to body, and I'll pull this all the way out into the future. There is this. There you go. Midline. This right here frames everything you want. Anytime you look for a long setup, you're looking for something premium. Anytime you look for a short setup, there you go. And that's the efficient portion of the run since 8:55. Extend it all the way out into end of the day. Now, your setup, where's the picture again? Was at 12 your time, so it's probably around 11 my time, and then there's a short. So 11 my time is somewhere in here, and I think it was M1. Let me just make sure.
It was at 10 o'clock Eastern and 11
Oh, but it was a
o'clock.
different pair. That's what I'm realizing.
Oh, yeah, it was. But it's kind of like the same, almost close to the same price section with NAS.
All right, so it's somewhere in here. You're looking for a short in here, but your short was targeting low of the day or
3 o'clock
Asia?
lows. Yeah, 3 o'clock, 2 o'clock lows Eastern.
All right, let me see if I can find S&P. That was it. So pretty much the same analysis. We want 7 o'clock. Why does this look like this?
You gotta do it's ES1 exclamation point for futures.
No, but this is intentionally not showing me. There's a way to get it back. I think it's something I don't remember.
Real trading hours, maybe.
I don't. You guys know how to do all that, but I'll do what you said. It's ES1.
Here, use this. I'm gonna type in the chat. This right
Okay.
here.
ES1.
Yeah, exclamation point.
Okay. Okay. Here. So pretty much the same. This is the initial high. This ran. It didn't take the low. It took internal lows here, and that held, and we traded higher. So you're watching that high. It gets taken. That means the next time we trade through here, you're buying a retracement. Target is going to be closing price of this guy right there. That's your target. So when the market trades through here, no retracement, it runs up, same idea. The only difference is now, since this closed above here in the same way the other one did, this is your inefficiency, starting at the open price here, or it can go body to body, all the way down. All of this inefficient. In real time, you'll be marking it here and in here, because this is 2 consecutive red candles. All this is inefficient, especially with no wicks. This right here is the most premium portion of this inefficiency. So market goes down, it's coming right back to the same buy setup. Expansion, fail, order block, candidate, validated. You're long here or refined to a lower time frame, and your target is internal liquidity. Ultimately, you want to get back up here, but this is good. If it continues, this is good. If it continues, ultimately you want that and game over. The market, pam, 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 hits premium, trades lower, extend that out all the way, and every setup going forward you should be able to frame them around those levels. We don't know what they're going to be. We don't care, but they will be there. So on your chart, you are looking at a short inside here. I can see that short makes complete sense. I would want to get out at this low first thing, and then if it's pushing, but this is an order block, so I'm not trying to get the order block low. I'm more reading it. If we expand through the order block low, breakaway gap, lower prices. But whilst it is an order block, I'm not looking to. You can't trade against the arrays that you know. It doesn't make sense. So it's an order block, cool. Trade down, cool. It stops, okay. We have the same signatures again. An expansion here. Candle that closes below here. This candle is not closing below here. Just like this. Which makes this your order block. Which makes that high and a retracement equivalent to a buy. Retraces, did it get to the order block? No, it didn't. So this would run without you and you would watch it comfortably. Comes back down into your order block. You don't wait for CSD here. That's a rookie move. Waiting for CSD here, rookie. Even if this is a losing trade, you take that on the chin. This is where you limit in the market. You don't wait for secondary confirmation here. Secondary confirmation is this pushes, you're not buying this candle. This drops here, you're not trying to buy this candle. That's crazy. If we open and trade below this candle, it's the first time you should entertain taking a risk. This one. But you're taking this not to get to here, but to get to the order block high. Here. That's a scalp. Very aggressive, but very, very potent. Done. This, unless you're trimming and leaving something, you're not in this. You're not in this unless, again, you're just degenerating your way through, or lower time frames. M1 is saying that you should. Comes back down, limit. That's full on limit. All you have to do is look where you want to put your limit. Either the order block open, failure swings inside, but you're just limiting that. And then let that happen. It's probably a lot. 515. It went all the way down to 10 and went all the way to 64. So about a 10-point drawdown or less, unless I can't do math. Yeah, about a, let's call it 20-point drawdown maximum. And then it ran for like 50 points. That's a win in my book. There you go. Partials, break even, whatever. I think this was probably the noon spike. Same thing. Expansion. We fail. Order block candidate. Trades above. The open of this candle, when it goes down, you're buying. And then run. Higher, whatever target you're looking for. Expansion high would have been here. So let me pull that out so you can appreciate the beauty of precision, not form-fitted madness. Trade done here. I don't care who's telling you that you're holding a retracement here. Trade is done here. Holding this is entirely egotistical and up to you. Expansion fails here. This is the only candle that closes above here. This candle's high is the last time we closed above. So this is your order block. So again, same rules. This candle's low gets taken, you sell a retracement. This candle does do the whatever you want to call it, it doesn't get down there. If the next candle opens and trades higher, you sell that. And if it stops you out, take it on the chin and that's it. Multiple short entries. Done. And as usual, I'll walk you through my textbook play. Equities open is coming in at 8:30. So I am gonna grab the low of one of these random candles in here. This one. And I'm looking for my order block. There we go. There was no news today that I know of. So that's my level. This is my order block. I want to buy when this candle's high is taken. So if it's trading below and it does not immediately get there, I don't have to participate down here. Now I start looking at my confirmation as near-term targets. Down. Expansion, run, blah, blah, blah. Maybe you could take a loss in here. No worries. This candle, 844, you're buying when we open and trade lower here. That's a buy. Target here. Partial heavy, break even, because this is potentially low of the day. That's why I'm break even here and not cutting the trade here. Now you're looking for not a pullback and then go. This did not pull back, and I can see why, but just entertain the idea that when we're doing this, take this high, retrace, and you buy. Doesn't happen. Just going, and then from here, it's all about the inefficiencies we talked about on the higher time frame. So this could even be refined if you want. If you're refining it, this candle at 13 is the last time we closed higher. So you're just knocking that up a little bit more for precision elements. And that's your order block. This is your breakaway gap right there. So if it gets there, IOFED. If not, lower prices. And the rest is a no-brainer. So again, here you could tighten that up to that candle's high, since that's the red candle as well. For precision, so you get less drawdown. And then your trade ends here. Your order block prints there. Your CSD, your short here. And 145 down to 100 is a decent trade. No big deal. Do the same on NASDAQ. What is this? My gosh. When the GBP USD be part of my watch list. Silver. This account is years old. years old. US 100 TVC. Yep, definitely years old. Because I only use, where is it? Capital Com to analyze NASDAQ. So same thing on the 1 minute chart. I'm gonna assume that you've already done this. So 32 is that red candle? What's the green one? That red candle there. Trends down, same idea. Order block. No, just going. Take a loss there again as usual. Right here, below the open of this candle, you're long. Target that red candle's high. Again, we have pullbacks inside here, so retracement not necessary. Runs up, breaks away, it's gone. Same inefficiency idea. Refine into here. Should you need perfection, etc., 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 etc. I don't think there's anything else to talk about. But that short, which was probably somewhere inside here, it made a whole lot of sense, but your target was just wrong. In my humble opinion, your target was not realistic. With an underlying bullish bias like that, you don't want to target lows in a bullish bias. You want to target discount, and discount means usually a raise or internal liquidity. If the market's underlying bullish and we've already run sell side and it starts to expand, looking for another major low to be run just to get in is kind of, ambitious. But if you can see an expansion, you can say, okay, cool. We expanded here. These are internal liquidity. These are my breakaway gap. These are the levels where a key level or a P area should print. So you don't get caught in, do I enter here? Do I not enter here? I traded this morning. Where was it? Let me check my phone real quick. I'll tell you. So it was there's a big drop and a pullback. And here, I traded in here today. Should be very close to 11 o'clock. So I had a scalp here to here, 2 positions. Then I had a scalp here to here. I had a scalp here that I added in and I cut early. And then I scalped here to here and here to here. And then my next trade was a long at 1209, 1208, 1209, there about 1209 here. That long. I played that long. That's the last trade I took. And then that ended my day. So none of these are weird. None of these are strange. Here comes the rooster right on time. I'm looking at all of this expansion legs. So let me just clear up all the drawings for a second. And I'm going to weave a little bit of inside joke. When this expansion started here, we have the start of the hour coming in there. So you have efficient delivery followed by that break right there. So everything above here inefficient, which makes this right here the efficient portion before that. And since this is the start here, let me clone the line. This is what your standard market maker model looks like. That's not an assumption, that's a fact. So you have the initial range created, 50%, do not 50% should do. And you have all of that. So I don't know. I don't remember the exact elements of the market maker model. I know there's a smart money reversal, low risk sell, blah, 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 blah. Once we hit this here, when we come down and we hit this, this is your support in the market. You don't want to see this broken. They could put an order block there, like close below and then go back above immediately. But you don't want to see them expanding through this. So your limiters automatically become trading here to here. That means, use the gun box. Your range of opportunity lies there. So for the folks who care about premium and discount, internal buy side above here, order blocks print, short them. Internal sell side inside here, we take them, you long. That's it. The closer you are to this, the less likely it is that you're going to get stopped out. So if you know that the low is at 1720, you know, you don't want an entry that's too far unless you have somewhere clear to frame your stop. But this becomes your support. Yeah, look, can't bother find a better word, support. So just watch. All of this here, it's printing around mechanical levels. Okay. So somebody in the audience, depending on who's here at the moment, is going to automatically look at this and say, oh, I know what I'm talking about. Somebody's going to not. What matters is you see it in real time or hindsight, whatever. But this logic is something that you should be aware of, and you should write it down. When hourly candles open like that, you have the open price, it chops around the open price and then it expands. This is your initial range or your accumulation in the market maker buy model. Some fancy terms is what we like. It's market maker buy model, that's what it is. Or not. But everything here outside of that should make sense. If this is your model, your market maker model, then at consolidations, you know what's important, EQ. This is the expansion. When markets expand, they don't expand and reverse, they expand and retrace. And if it's going to retrace, retracements seek imbalances and inefficiencies, which is exactly what this is. Like the moment we saw this, we know that that's what it was on our M5. So when these overlap, you target inefficiencies. When we close below 910 open price here, this is no longer about inefficiencies. This is about an efficient range like this, which means in an efficient range, you do not focus on imbalances. You focus on equilibrium because efficient ranges are synonymous to a consolidation. We have market going up and down. The equilibrium or 50% of this efficient range, when we get to whatever time that was right there, is still right here. Yes, there's an FEG. Nobody cares if there's an FEG there. What you care about is that. You sell that without thinking about it. You pick the high. It's going to be nice to pick that high because what? Consolidation, expand, retrace, reaccumulation, aka offset accumulation. Then it starts to run. It's going, you're watching here. That's the 50%, that's the array at 50%, has to be important. This is just a beautiful delivery. When you have a key level, run towards it, fails, takes it out, CSD, no brainer. This is expanding. This is your order block. Did it take here? No, don't sell. It expands again. Right there. This is your order block. Did it take that? No, don't sell. Here is the last expansion. We now hit the key level here. The moment this candle closes, I want to sell aggressively because we have our expansion, 2-bar, drops, doesn't take it out. I know my key level is this open price. So if it trades back into that level, or in this case, it's at that level, you're gonna need, yeah, I'm selling that, full stop. When you sell that, you're looking for the last time the market, this is now the order block. So yes, you can look at it as an expansion because you want to get in early, who cares? This is the last expansion. So in your mind, you should see this there. You pull that out in time. When this low gets taken, one of two things are supposed to happen. One is a retracement, and two is what? Let me see if anybody knows. What is two? In these environments, two things print at this low. A retracement or a dot. That's it. A breakaway gap. This is still a change in the order of delivery. See, we're tracing inside here. Why? Why does that make sense? Because this is your key level. This is not your buy side run. This is not the buy side run, which means this dealing range started with a drop that did not take out sell side. So when you're bearish and there's a drop from a high that does not take sell side, we call that a dot. Nobody knows?
Failed expansion.
No.
Failure swing?
Failure swing, yes, but we don't use failure swing in dealing range logic. It's okay. Failure swings in dealing range logic is when you understand, so you can call it whatever. But when you're communicating, dealing range includes 4 elements, and they are, what are they? You have to know. You can't not know. You have to know. Buy side, sell side, and then
Trace
and expand. So if we start going lower first here, this is the what? No.
Retrace.
As a retracement. So 4 steps. Retracement, buy side, what's left?
Sell side.
And
expand.
So then when we take here, you don't expect a deep retracement. And that's how you can start going aggressive here. Like I would short this candle here. When it trades back up right there, short. Suffer some drawdown and then capitalize on all that. So now, let's throw this in at no extra charge. If we know that this right here is a breakaway gap, what does that mean? Nobody knows. If this is your breakaway gap right here, let's take off this, right? If this is your breakaway gap in a run lower, and it goes all the way back down into the consolidation or to the sell side liquidity, whichever is there, what does that breakaway gap offer you?
Inefficiency.
Do not close it if bullish. What?
Inefficiency.
Yes. Well, efficiency, yes, but that's not what I'm looking for.
Yeah, if we close above it, then we're changing the delivery.
That's it. If the change in the state of delivery happens when they close above that. At 10:44, you are bullish. I know you see what comes after, but humor yourself. At 10:44, when this closes above, you're bullish. Okay? You have all the support structure you need. You have all the targets that you need. Here, all the way up here where they get animated. You have everything you need for a buy. But you are here. Automatically, you want to run lower before you're going higher. All you have to do now is just identify where you want to enter. There's lows, there's key levels, higher time frame confluence, doesn't matter. You can now confidently say, if this, then that. If it retraces the here in CSD, I'm going to buy. Simple. Now let me throw this in again, no extra charge. Gems galore today. When it trades down, you don't limit entry that. You don't limit entry this. If it trades down, fails to expand, CSD, runs away without retracement, you limit that retracement. But if it CSD and retrace immediately, then you don't need to limit, just go. So all that rundown, you don't limit that. You can't limit that. Unless you're just that good to identify exactly where it's going to drop to. You allow that to print. Allow them to expand, allow them to fail, allow them to CSD, which is a no-brainer, and then you buy. And I don't know, somebody's trying to figure out where this is going to. And all I'm going to say is just go if you care about it that much. And you fib from that high, that low, right there. You want to take out the lines, I'll take out the, and you go right there. Equilibrium of the consolidation. Just make your life a little bit easier. Focus on that. Wow, it's almost like this thing makes sense. There you go. So again, I'm not saying you should limit this. I don't believe this buy should be a limit. Not because it was a nice example here. Don't limit that. It's CSDs. What do you need a limit for if you can get this and I put a stop below here? And then this runs from 122. You don't need anything. Same thing here. It comes back down. You're not trying to limit that. Run on liquidity. See all that run? When it CSD is right there, this candle here at 1156, that's a CSD. Did it retrace for it to get in? No. So why are you trying to buy here? Why are you trying to buy this FEG for? You like to buy FEGs. You just grab the order block. Shouldn't be that difficult. In some cases, if you want to frame risk, you can just pull the box down here to give you an idea of what the risk looks like. But realistically, the order block body is enough. Unless there's more wicks than body, and you might need to factor in risk. I mean, your trade ends here. Like your trade, full stop. If your trade is not ending there, you're pulling this out. I can't pull it out. Where this thing, the thing in the middle one doesn't come up. There we go. This hits it perfectly. Can do an ICT. The open price is 635.3. The high is 638. No, I can't do ICT. Catch you another time. Funniest thing ICT has ever said. Listen, folks. I don't know where you come from, but where I come from, that's perfection. Funny guy. But here it is. Straight up to the order block again. Again, this is a PD array. You're not looking to target the higher the order block like a crazy person. It's a PD array and it works. So when the market comes back, respect the PD array. If we do that, then you participate. But don't call it in advance that, oh, it's going to not work. Okay? You do that. And from there, it's just a no-brainer. I'm not going to pull the bag out and say, oh my God, look, it stopped at EQ again. No, that's not relevant. This is more important. Retrace, expand, retrace, push. So FEGs in here is what I would look at reasonably. Once it expands, you focus on the FEGs if it's coming back down. And if there are multiple FEGs, then again, it's a no-brainer. So you would grab and it'd go expand, FEG1, FEG2. Right there. Disappointing, but that would be the level to pay attention to. But I don't see anywhere that you could go short here and not make money on that. None of them at all. But that takes us to the end of what is this?
Hey, Kish.
Hold
on. In the kitchen video, you gave us two different examples of deliveries with the failed expansion.
Mm-hmm.
And I just want to get clarification on something for myself, I guess.
Okay.
Can you go to like a bearish failed expansion or bullish, either one?
And let me clear up the drawings.
All right.
So this is a bearish expansion. This is when a bearish expansion has failed. So I'm marking there. Okay. What's up now?
Okay. So this is the bearish failed expansion. So one of the deliveries you gave us where, like, say this was this right here, is this this is my question actually. Is this the top, like the beginning of the expansion, or is this the last candle in the expansion? Because you gave us the delivery like this or the delivery like this.
All right, so let's talk about it. When you're looking at expansions, you're ideally looking for consecutive down close candles that are closing below each other.
Mm-hmm.
In this case, down candle.
Mm-hmm.
Now let's redefine close below, no close below.
There
this
we
is
go.
the truest portion of your expansion. These are candles that went lower, but you know what this candle is for. You know what this means here. You know what all of that means in terms of the setup.
Mm-hmm.
But this is the truest portion of the expansion. First thing is, if you have no bias, your PD arrays are going to form here or here. If you have a bias, then you could start interpreting this from a if this then that perspective. Let's say you're bearish because this went lower. Let's use the hindsight to our benefit. If this is expanding lower, right, you can even hide everything that comes before it. If this is expanding lower and you're bearish, you're expecting retracement followed by a new low. Fair?
Yes.
You don't need an order block in this run.
Makes sense.
Make sense? Because retracements don't target air quotes, liquidity. They target inefficiencies. Sure. So you're gonna have to frame an inefficiency in this range. This range is going to denote price, not time, for this example, of course. So how do I frame an inefficiency in this? I want a low that's above here to the left. There. No cherry picking. That's the first one right there.
Mm-hmm.
Now that I've framed my low, now I know I want a certain type of delivery here that suggests a continuation lower. I don't need an order block. What do I need? A change in the state of delivery. What does that mean? It means, when did the market get here? No brainer. We don't read price left to right. Don't try to pick. We read left to right. So you pull this out until we touch it. There we go. What does a change in the state of delivery look like in real time if you're watching this?
Wick.
I need something better than that. At 1:35, the market hits the FEG. What does a change in the state of delivery looks like here? You guys hesitate too much.
Trade below the low.
Amen.
Oh yeah.
you overthinking. When it trades below this low, what would make you sell?
Retrace.
Amen. That's it.
Gotcha,
there is no magic to it. It trades below here, retrace, and you sell. The market went higher. Who cares? You only care because you want a better entry for risk management. But once you're reading this to frame direction, this is just for entry. This has nothing to do with your direction. This is direction. The thing is, most times we see this and we can't stand the idea of market getting all the way down here before you get in. So you jump the gun. You get stopped a couple times and then it runs and you're like, that's fine. I have no issues with that because that's all about risk appetite. And there's no way I can tell you what your risk appetite should be. What I'm telling you is how you can reduce that. This right here sets the stage for what you want to see. There are intricacies in this that you can pay attention to get you in the move. Such as the fact that green candle, close above, stop closing above. That candle's high becomes your bullish expansion. It fails, we close, order block. Trade through here, you're ready to sell. You're ready to sell here. That's it. Now let's look at what the big difference would be in reality, because you're going to see some examples where the difference is astronomical. And in some, it really doesn't matter. So let's look at what an entry setup looks like after the market trades through this low and after the market trades through this low and the retraces. Trades through here, pulls back aggressively. You don't know what you want to sell now because it looks like it's closing above. You panic. You don't do anything. Worst case scenario, you sell and hold and you panic or whatever. Real time, realistic approach. That's the low. This closes. We have a green candle, CSD by a green candle. Whether or not you were in this trade, I mean, assuming this opened and went higher first before going low, I take that loss on the chin. If this opened higher and then lower, I take that loss on the chin. If this opens and just goes lower, that's not for me. I don't want a green candle CSD and a green candle for me to short. Around certain parts, we call that by certain names. Nonetheless, market starts to trade lower again. I'm interested in going short again. But this is now printing a dealing range. Anytime you have a key low or key high that you're looking for delivered to print around, just think about dealing ranges. Buy side, sell side, retrace, and expand in that order. Whatever the order is dictates to you what you want to look for. If you, for some reason, are unable to read the order, then you say, if I'm bearish and I have a key low, when we trade to the low, I'm either thinking about the retracement or a breakaway gap. If you want the retracement, it has to go back above here. Amen. Simple. So you look for the swing high, down to the swing low. I mean, automatically, this is not the case because this is higher. So swing high, swing low. Now you have your range. Amen. If not, you're looking for a close and an FEG. This doesn't close automatically. You can't think about the FEG because this hasn't closed yet. This prints, order block. Amen. CSD, trade back up into that, short. But then at the same time, this would run lower after the CSD without going back higher. So you automatically still want to go short in here. Short. Stops on here look crazy because of today, but on a normal basis, it's not going to be this bad. But stops in here today is astronomical. So if the stops look astronomical in any delivery and you're certain or you have a high conviction for your direction, wait until the market starts to trade in your favor and sell above the open prices. It drops, nice. Open, goes up, sell. Opens, goes up, sell. I'm not gonna say open, go up, sell every single one of them, right? Because now you're starting to read the delivery. CSD, both of those are done. You want closes below these lows. There's nothing more to retrace for. It's overlapping wicks. There's no FEGs. Is a monster? Where's the monster? It's in the kitchen. Okay, I'm coming. I'm coming. You want the so you want the close below these. The moment this happens, you're happy. Happy as a lark. The moment this closes, you are happy. Now you start thinking FEG stay open. FEGs that print here will stay open. There are no FEGs in this case, but that's your thinking because we should be wanting to leave this area. There's a low before. I mean, I'm eyeballing this low in reality. This Wixit, FEG through this low, please. Not, not the most ideal of deliveries, but you can't tell me if you go short at 17,535 and the market trades down to 17,431. You don't know how to live with yourself because that's just disgusting. And who gets 100 points in a couple of candles?
I know.
I'm just saying because people like to dissect everything. Like they try to catch me in something. Oh, you said this and it didn't happen here. Ha ha. Okay. Consistency is not about always hitting the top. And I've shown that I don't have, but it should go without saying. I'm not 100% accurate. I'm about 70. I get quite a couple of losses, but I stay green. So
yeah, I was done early today after on a CSD. I got like 40 points done.
Yeah.
it was so quick.
Bro, this was 300 points. This candle right here. I watched it happen. And I was watching the macro print and I was like, I can buy this here. But because I said that I'm not engaging a lot, I just left. I didn't even put it in the leap. In the leap, I bought Ethereum USD. And then it pumped. Like, look at that. Then I closed and I just ended. Nice. And then when it came back, I'm like, you must like me. So 1209, 1208, I went long. Like, it's a given you went long. You just go long and then it just runs. And naturally, you're looking for, if we have a range and it expands and retrace, if we're bullish, we're making a new high. What's up? Well, yeah, you're looking to make a new high. It's a no-brainer. Expanding markets, if they're going higher, they make new highs. I didn't hold for all that because this is a lot of points again. So I just ended my day there and then tried to find good music to listen to. And then I just felt like you should do a call. But I wanted to go play chess. I'm like, how do I do a call? I want to play chess. Why not do a call playing chess? That's how all of that came about. But I think we talked about a lot of stuff. I got a couple of games in. I will try to squeeze one more. I think I lost that one on time. Should have been a winner, but
Kish?
Hola.
Oh, sorry. Can I ask you just one question? Oh, you're playing now?
No, you can ask me. I can multitask.
Oh, okay. All right. With regards to expansions, so because in my study, I'm asking this because I also shared with other people and I do not want to share something that is false. I observed that expansions that have FEGs in them and expansions that do not have FEG in them behave differently. Most times the ones with a FEG requirement and OB and like you've explained so far today, whereby the ones that do not have one, a 2-bar or like the barricade logic is enough without the requirement for an OB. Of course, those ones too also can print with an OB and then you apply the same logic. And so I wanted to confirm if that is true, like expand, because I call one type 1 like FEG and the one without, and you know me mechanically, and I just build rules around them and just trade like that. But since if it's for me alone, it's okay for me to accept that. But since I also share my studies with others, wanted to confirm and wanted to ask that question. Yeah.
Sounds good. It's not a matter of if it's something that repeats by itself, but more of does data suggest a higher probability of those setups playing out? That's much better than, you know, the approach for perfection, in my opinion. So if you notice that FE expansions with FEGs are much better, then try to build your model around executing on those. I think, if you get what I'm saying, maybe
Yes,
it's a little bit tongue-tied.
I get what you're saying, and thank you.
This guy's trying to trick me. Let's do this. Hide this inside here. No, you can't do that. I'm pretty sure that loses a piece. Pawn takes, queen takes. He's getting away.
Kish, can I ask you a question quickly?
Always.
Just wanted, I joined a bit late, so I'm just wondering, will this be uploaded onto YouTube or where will it be uploaded to?
Usually YouTube.
Just in case you change your mind or anything, do you mind just running over the thing when you're talking about the expansion and the order it comes in? Because that's when I joined and I missed a bit of it.
I can do that.
Thank you.
This should lose a piece when I go here. Unless he goes here like a crazy person. Nice. So now I put my queen here, put the pawn there. Good Lord. Did I mess this up? Resort to cheap tricks now. So, order of delivery when you're looking at a dealing range is going to be the same. Buy side, sell side, retrace, and expand. That's what you want. That is the easiest and most efficient way in which you can find. I just blundered. Good Lord. Buy side, sell side, retrace, and expand. You get strength from looking at the order in which they form. No, you can't do that. That's just bad. Queen here is not is bad. Queen here is probably better. Okay. Queen there is free. Wow. This game is very chaotic. My gosh. No, you just. Oh, too slow. Whew. Anyway. Yeah. Buy side, sell side, retrace, and expansion is usually how dealing ranges are created. So what you want to pay attention to is when you are trading towards any pool of liquidity, whether buy side or sell side, what does the market start doing? Most times it prints like this. If this line here represents a liquidity pool, then you get something going towards it. This is classic. This is classic. What you want to be comfortable seeing See, these points here are important. This is usually the last expansion, retracement, liquidity pool being taken. Then you have this change in the state of delivery, retracement into the order block that gets created here. And you have your classic RR tool slapped on this stop at the high and then blah, blah, blah. Okay. What happens sometimes is a variation of this, where you have this low being lower than the point where the CSD should be, but it still retraces. So what you have is a buy side push. So that's a retracement. This here, buy side and retracement. So you're looking for it to get here and then don't come back. Like that. So sell side and expand. And if I may, let me just change a few things here so this can look a little bit more beautiful. And for the good folks who like fancy terms, this is what we'd call an IOFED.
In this particular example you're showing here, I've seen it happen numerous times and I tend to get tripped up with it. So where the bag is supposed to come through, my understanding is when we close a bag, that candle that closes it becomes a mile marker for you. So if we close back above the candle that closes this bearish FEG, that's a sign for buys, no? Or
yes.
So what happens when you just continuously close the bag, if that makes sense, and you continuously close the candle that closes the bag?
So you print a bag, you close above the bag?
Yeah, then you close
higher
below
prices.
it again.
You're looking at higher prices, or this, if the market is predisposed to go lower, and it's printing bags and closing them. I've seen this happen in particular close to the end of hours. So let's say 10 o'clock is coming up. And let's say that's 10 o'clock. And we are here. And you know, everything from your model says this is going lower. So you're trying to get in and hope that the hour just dies right at the open. But then it stays, not necessarily closing the back, but it stays here a little bit longer. The structure, everything is there, but it's just not moving lower. It's just staying there. So you end up having like drawing. So you have a down candle there, followed by up candle.
Yeah.
Followed by like another candle. Most times they're wicky, so you have wicks on both sides and the body just staying inside.
Yeah.
There is nothing that I can say prevent or protects you from this. You have to just wait for this to be finished. Sometimes it being finished means the move is gone. Yeah, that's just one of those days. Or you focus on the mile marker. So if this is a down candle and then this comes up as an up candle, all you have to do is eyes on this low. Eyes on this low. If it's getting really close to the end of the hour and you're trading a rotation, chances are, if you're playing rotations, you want to leave it alone. If you have no idea what rotations are and you're just trading, then you tighten the risk. You look for the bag. If there's any wicks or candle that went above the bag, you keep your stop above that high, that candle's high. And then the expectation is that the next move is going to do this. Let's clone this. It's going to do this and then gone. Yeah. But I've seen this happen a whole lot of times. It would be nice if I had an example. Bam, 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 bam. Yeah, no great. Kind of like here, where you know that this is likely to go lower, but when it gets to the point or the low that should trade through, it just stops there.
Yeah.
At that point, in like just like in this case, you have to look at the expansion and then you say, okay, since this is a clear expansion, if it's not trying to move, then it makes sense if a retracement gets back here. So you enter early. If it stops you, you just stop. Or you don't enter early. If you don't enter early, then you're probably going to get a less ideal entry, which depending on where you are in the overall move could still be favorable. But I have found that when you have clear expansions, retracements are just drawn to the inefficiencies in them. Like we just do that on the chart, and wherever it stops, it stops. We don't have any candles here. I think probably because chart's crunched up. There. So look at anywhere here. Let's start on the left. Green, 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 green. Inefficiencies, it come back. This is now expansion through an expansion, which by definition should create BPRs. Just saying. Wink, wink. Kidding. Wink, wink. Still. Or goes down again. Look for inefficiencies. Comes back up. Great. Again, expansion passing through expansions. Create BPRs. Same thing here. Same thing here. By the way, that's when you're likely to see this type of setup, in case you haven't studied it enough. If you have expansion, then expansion, this idea. Please stop. There we go. This idea plays out more, where the start of the old expansion and then the new one acts like resistance turn support or blah, 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 that type of thing.
So would you still wait for your PDRA to produce at the opening price of the first expansion?
It depends.
Okay.
If this expansion is taking place at a key level I've already determined, then I don't need secondary confirmation. I mean, but if this is just trading one-sided and the expansion is creating the key level, I need that delivery. So let's say, where's my line? Let's say I see this run up, expand down, and I look at here. I'm like, okay, cool. That's the body, or that's the open price. I'm looking for something here to participate in. And let's say it expands away from here. So let's say this expansion happens there.
Yeah.
Then I have my inefficiencies. So when it comes back, trade. If I'm watching this and it drops, creates an up candle, then it displaces. This is not a displacement through, not one I like. It displaces. So you see like how this goes up and then crushes. If this fractal happens right here, when it comes up like that into the up candle right there, I'm limiting in. I'm entering before a CSD takes place.
Okay.
First time it comes in. Because then I'd already have my key level, the delivery at the key level. What am I waiting for here?
So the difference is displacement.
Yes.
Okay.
Displacement shows you things. It shows you the inefficiencies. And when displacement, because think about it for a second, right? We like when something we know happens somewhere we're expecting it. That's it. I like when I go to the grocery shop and they're selling the groceries I want. I like when I go to the car mart, they're selling cars I want. But if you go to the grocery shop and they're selling cars, then that's a different ball game. That's kind of how I interpret charts. If what I'm expecting is happening where I expect it, I have nothing to do but engage in a transaction. If it's a buy, I just buy. If it's a sell, I just sell. But if I'm,
yeah, okay,
then it does. It stops. It stops being rule based and more being feelings. I feel like this is what I should do here. No, I've been there and I've lost money and I'm not trying to go back there.
Yeah.
So that's why I spend a whole lot of time over the years practicing how to find key levels, open prices. When I have an open price, what makes it ideal for trading? When I have certain things happening at the open price, what about that tells me direction? Little bit of sprinkling for those that are listening. Those things tell you things. And then all right, let's create an idea now that says anytime we have expansions and they have overlapping wicks, 50% is generally key, right? Let's just create that. And then we go look at any expansions here that don't have FEGs. FEGs. Here's a part of an expansion here that has overlapping wicks. So then if the theory is true, if I go wick to wick, wick of the first candle, wick of the last, it would be this one. Because I'm looking at this candle's low at 31 because this candle has a displacement there. So if that's true, if that rule is true, where it says expansions with overlapping wicks, they're 50% offer something, then it means automatically I'm expecting that price level to show me something. I don't know what this means, but if I have a level and the delivery at the level is a rejection and a failed expansion, I don't know what's going to stop me from selling at 675 and trading all the way down to get 50 points. I don't know, but I'm taking that. That's how simple these things are. This is not an expansion, so I'm not going to use that. This is not classic definition. It's consecutive green candles. I don't parlay with that one. Expansion overlapping wick. FEG is there. Expansion, closing below. Same thing. No, this didn't close below. I'm not going to spend a whole lot of my time looking for them, but just saying, if you have a rule like that and the rule creates your key level and you can see like here, there is no FEGs in this. So I go from wick to wick and I pull that out in time. Behave. There we go. So this wick right there, let's pull it over so you can see it. And then that one right at the high. If I have a rule that says that, and then this displaces here, I am buying below this candle's open price. When this opens and trades lower, I'm buying that. And I'm targeting new highs. Doesn't look like a lot, but the open is 92. Let's say I get in at 88. This takes me all the way to 12. Maybe not a lot of move because this range isn't ideal. What happens when this is an H1 chart or a daily chart? God forbid a weekly or a monthly chart. Then you can see your directions even better. And that's when you get better framing what you want to see. Okay. Then it comes down and it closes below it. What is this saying to you in terms of direction? That you should buy the next CSD? Of course not. That's what I'm saying. It takes the low here. Buy side is already taken because the top of that is already taken. We've already chopped around inside here, no biggie. Then it takes this. I'm looking for this to run and make a new low. It runs here. It comes back up. You need a change in the state of delivery. You don't need an order block. Which means up candle, when it takes this low, I sell a retracement. I sell a retracement here. And if this ever got back to that FEG there, I'm selling that again. And I'm selling this right there. I'm selling this. And I'll probably sell this too. And then doesn't look like a lot, but 3 positions here, let's say 0.25% risk. When they start running 50, 90 points, you're good.
When does your retracement change the bias? Do you understand what that question means?
Mile markers. You need mile markers. Meaning, you have to step away from the I don't want to sound too much like ICT and say school of thought, but you have to step away from the ideology that says when you go to the chart and you have a bias, just look for an entry. You have to step away from that and start looking for when I have a bias. Remember, we trade against bias. A lot of persons open their charts and they're bullish, but they sell to buy or they buy to sell or whatever. So you have to step away from just going to the chart and looking for an entry and start going to the chart and looking for what supports a particular direction. So I am bullish, but we're expanding lower. There's no fail expansion. It's retracing inside a bearish expansion and not breaking through and changing the state of delivery. I'm selling that even though I'm bullish. But what happens when I am bullish and I see sell side taking, we're expanding higher, we're tracing in the FEGs, order flow is going back to being bullish. You buy and hold. So that's why you move from just looking for entries, you look for the things that supports your direction. Your bias is bullish, but you're getting bearish expansions. What are you going to buy the next time we wake up over down candle high? You must be crazy. You must
make sense.
And everybody can relate to doing that, right? You're bullish and candles are just closing. And the first time it wicks a down candle high. Order filled. Oh man.
Thank you, Kish.
All good.
Sorry, just last question. It's just a clarity question. I'm not sure if you remember, but the YouTube video called The Gist, where you drew the lines of delivery, is that the lines, does that represent the dealing logic explanation you just gave us, where you're talking about sell side, buy side, retrace, expand? Is that what those lines represent?
So I'm gonna tell you something now, and I hope you understand what I'm saying. See, anytime I go on, I say I'm gonna do a call.
Yeah.
I 90% of the times, maybe 95% of the times, I have no plans for what to do on that call. Everything on the call is inspired by the conversation. So when you ask me about what I talk about in a particular video, yeah, I can't tell you. I don't know.
No worries. I'll go look into it again. Thank you, though.
But if you show me something, I have a pattern memory. If you show me something like a drawing or a chart, it will spark my memory.
That's okay, I'll send you some messages then.
All right, cool. That's why I always say, guys, just ask questions, send charts. I work better than you hoping that I'm going to talk about something that you want to hear about. No, you have to inspire the conversation. That's my mind works. But good talk. I don't think I'll play any more chess. I think that's enough. I feel like I'm fulfilled now. So I'm gonna go outside, stretch a little. I have about 40 more push-ups to do to finish the 100 for the day. I won't do that until later though. But thank you for providing this outlet. I feel like I needed it.
Hi Kesh, I joined late. I just wanted to ask if this will be uploaded on YouTube or anywhere.
It will.
Okay, perfect. Thank you.
All right, cool.
Thanks for your time.
All right, guys.
Thanks for your time,
coming
Kish.
on. My pleasure.
Thank you, Kesh.